Hello, good morning. Today, I will try to explain what's the difference between a company and its stock. Okay? Um, there's a very big difference between them, and I will explain. So, for example, we take a company, any company, for example, XYZ. This is a company. Okay, this is the stock ticker or the stock symbol. It's called XYZ, and for example, it's a company that's doing. For example, it's a bank. It's just an example. It's a bank. Okay, the bank, and in the stock market, it has this ticker. Okay, now this bank is doing business and it has earnings. Okay? It has earnings. Now, the bank, when it goes to the exchange to be listed in the exchange, for example, let's say NYSE, which is the New York Exchange, it gets listed. For example, we give you just an example. It is $20. Okay. Now, it's $20 per share. Okay. Now, there is a relation because this bank has sold shares to investors and to traders. Okay? So, the people who have risk, the most risk is the investors. Okay? Because if many other investors, they buy this bank symbol, they buy the shares, it go up. They force it go up. Okay? From 20, for example, to 30 in, for example, 10 years. Okay? So those people who buy, they know the bank, they know it, and they know that it makes good earnings, and it's expanding, and it's a very good company. That's why the investors, they buy. Okay? But sometimes, events that happen in the United States or in the world make these stocks go down without any reason. This is the problem. That's why who controls the banks here? Okay? All the people who are like having profit from the bank, CEO and the other executives and the other control the bank. They are making money from this bank. They got bonuses. These people are getting so much money, and they have free shares from the bank. It means they have a lot of money from the bank. It means they are making money. They have good earnings, and they are making good money from it. Okay? Now, and most of the time they are safe. They are getting their money, their salary, their bonuses. They are very safe here. Now the stock, it is not safe. The stock is not safe. There is always what we call a risk. Why there is a risk? Because it is in the hands of investors. Okay? It's in the hands of investors and traders, hedge funds, and hedge funds, mutual funds. Okay, all these people hold a lot of millions and millions of shares for the company. Okay. For example, it goes from $20, it goes to $70, for example, in 5 years. 5 years. Okay? I give you just an example. From 20 to 70. The bank is doing good. The people are buying it, the mutual funds are buying it, the hedge funds are buying it, traders are buying it, the investors are buying, all the people, and they do some advertisement. Okay, this bank is very good, and in the exchange they give good news, good news, good news. Analysts, the bank pay analysts. They pay analysts to say good things about the bank because they have good earnings and they have a lot of things. Now all the price is going up and up and up and up. Okay? Now, something happened in the United States, like an accident or anything else. It happened in America, and you see that the stock market, it has nothing to do with the bank. Nothing to do with the bank. And you see it goes from 70 to 50. Okay? It goes from 70 to 50. Although the bank is the same bank. It makes the same earnings. It has no problem. That's why the people, they get confused in investing and in trading. They think that the bank is good, so the stock will be good, which is not true. Sometimes good companies, and you see their stock is going down because these guys, mutual funds, hedge funds, traders, investors, they just either they sell their shares to go to other companies, or they short the company for something. They just short it, and you see the price going down. Now, when the price is going down, all the other people who have bought here, they begin to sell. That's why we have a very big sell-off. Now, as I told you, if there is an event, a bad event, bad news, some stocks or the whole market, you see the whole market going like this, up, and then they go down. And you ask yourself, all the stocks in this stock market, we have thousands of stocks. Different, for example, like what happened in the crisis. See the crisis in 2009? Okay? If you take the Dow Jones, okay, it's like this. 2009, it goes like this, and then it goes up. Okay? So when it goes down, almost all the sectors, industries, all they go down. Okay? You ask yourself, these companies, are they having problems? No. Most of the companies, they have no problem. Okay? They have no problem. Maybe they have more profit than before. But you see their stock is going down. Okay? So that's why I told you that there is a big difference between the company and its stock. The stock is always manipulated by big money. Okay? A stock, they can take it up or they take it down wherever. Okay? So that's why it is the big game. Okay? It's called the big money game in the world. Okay? People, they put their money in the stock market. Some people, they short these stocks. Hedge funds and mutual funds or other, I don't know. They just, like especially hedge funds, because mutual funds, they don't short. They sell. But it's the same because they are selling stocks of company. They short, and you see that the whole market, the big money, is moving from stock market going to another place. Okay? So that's why you see the stock market going like up, and then it goes down and goes up like this. Now, if you ask yourself why it goes down, what happened to the companies? You search for these companies, it was 50, it goes to 30. One is 80, it goes to 20. And you ask yourself, what happened to these companies? Are these companies having problems in earnings? And you go and you check, and you find that the earnings are good, are better, maybe they are better. But why the stock goes down? You ask always this question because the stock, it's not the company. The stock is most of the time is different from the company. It behaves according to the traders and investors, what they do. Okay? Investors, they want to buy a stock, it goes up. They want to sell it off, it goes down. Okay? So when you put your money into the stock market, so most of the time it's not safe. You always think about, as I told you in another video, think about the risk always. Okay? You tell me, for example, oh, there is always risk in the stock market, what should I do? Okay, if you don't want risk, go to something else, like do business. Okay? Why you go to stock market? You have your money, you try to make a business, and you will be getting more money than the stock market. But the thing is that people who have money, they control the stock market. This is a fact. The big money controls the market, and any stock, for example, a hedge fund. I give you an example. A hedge fund manager, he can go to any stock and he can short it. For example, it is $70. He short it. Now other people are scared here, like 65, 60, 50, 40. Those people who buy here, they get scared and they sell. Now when they sell, the stock goes quicker, faster and faster and faster and faster. Now this guy, when he says it should be like this, up, down and up. Now what is this thing that it is up? It goes down and sometimes it goes up. Those people, when they short, they should cover their short. Cover, it means they buy the share that they sold here. They sold here shares, for example, at 70, and they buy it when, for example, it's 40. So all this money goes to their pockets. And all these people who are here, who bought the stock, lose money. Some they lose a lot, some they go bankrupt, some they, I don't know. That's why in the stock market, we have always few winners and a lot of losers. And most of the people lose. It's just those few winners. If you don't know what's happening, but if you get lucky, for example, a stock from 20, it goes to 70, and you buy here 20 or 25, and you are waiting, it goes 70. You can make money, but it's not because you know the future. No. But because the other are selling, the big mutual funds or investors are the mutual funds are buying. Since they are buying in any stock, wherever the price is, I give you just a clue about the price. For example, it's $20. You put a line like this in the chart. Okay, this is the price, 20, like this. For example, it's a candlestick. If it goes up, just an example, 20, 23, 26, 30. If it goes up, you put a line, you see this line and you see that the stock is going up, so you are making money. Now, if you see like this, if you are going like this, 20, 19, 17, 15, it means that the stock is going down and you are losing money. You are winning here. Okay? You win here, you get profit here, you lose. This is the only thing that you can do. The price is always showing you what is your position. Are you winning or are you losing money? Okay? If you are losing, don't think that the stock will go up again and you'll be a winner. Because you don't know. Maybe from 15 it goes to 10, to $2. You don't know what's going on because maybe people are selling here, selling heavily. They are selling. Some are shorting the stock because they know that there's something going on, or they just short, and they take all your money. And when it goes up a little bit, you are happy. You think that that there is like a hope that the stock will go up. Now there is no hope in trading. Okay, so this is a general idea about what is the company and the stock. Another thing I want to say about company, which is a fact, it's dividend. Okay, it means some companies give dividend. It means they take from their earnings and they give you, for example, 1%. They give you 1% each year. This is called the yield. Or it can be like by money. For example, let's say $1, and the price, the share price, for example, is $100. It gives you each year $1. This is the yield, which is 1%. Now, this is the real thing. It means this money, it goes to your account when they give you the dividend, which is very good. But the problem in the dividend, or in this dividend, here is the problem. If the stock is 20 and they give a dividend, for example, let's say 100, just to be easy, 100 share, and they give you 1%. It means they give you $1 for each share. Okay, $1 for each share, $1. But suppose the stock goes from 100 to 90. Okay, and you bought, for example, 100 shares. 100 shares. So 100 shares is $10,000. Okay, $10,000. They give you a dividend $100, so it becomes $110. $10,100. But the problem is that after 1 year, it goes from 100 to 90. So here, are you losing or are you winning? Okay? So from 100 to 90, you lose 10% of the stock, of the share. They give you 1%, but you lose 10%. So you are losing $1,000 and you win 100. It means in general you lost $900 from your money. So you are here, you are a loser. Okay, your trade or your investing is losing money. So it's time, maybe you think, to get out from this stock. Okay, and don't stay. Next year they will add 2%. They ask you to stay because they say, oh, the big news. Okay, we will give you 2% this year, but stay in the stock. Some people, or 3% or 5%. Okay, just to stay in the stock and give them your money and the company invests your money. But the problem is that who knows the future? Okay, you stay maybe 1 year and from 90 it becomes to 70. So whatever they give you, like 3%, 5%, 10%, here what they give you, it doesn't compensate the loss. So you are always losing money. That's why when you see you are losing, you should stop and get out from this company and buy another stock. This is the only thing that it is reasonable in the stock market. If you stay, maybe you will have a big loss and you will lose all your money. Okay? So this is a general thing about the company and its stock. So hope you understand now the difference. That there are a lot of differences. It's not easy, but the stock market and trading and investing is different from the company itself. It's different. Those people, CEO, for example, or executives, they are making too much money from the company because they got bonuses, a very large salary. Some companies, they give them $1 million, $2 million, $10 million for presiding this company. $10 million each year is too much money. And they have shares, they have bonuses, they have a lot of advantages. And you put your money here, $100, and it goes to 90, and they ask you to stay. You will never stay in this. If you stay, you are a fool. Okay? You are just giving money to other traders here. They don't care about this because they are having money and they do bonuses, they do a lot of stuff. That's why you should make sure that you understand that the company is not its stock. It's different. Okay? This we have a lot of play. It's a big game. It's trading and investing. So it's a big thing. It's not like the company. Okay? So hope you understand all this stuff and the difference. If you have a question about this, you can comment or ask me some questions. Thank you very much.